All right, we're good to go. Hey everybody, Ben Hart here. This is Think HART 2023. It's been a while since we've done one of these, and I'm excited to have Mark Connors on today. Mark is head of research at 3iQ. I first got to know 3iQ early 2020. Had a conversation with the founder, Fred Pai. I was starting to think of crypto as an asset class at the time, and we can certainly dive into 3iQ later, but I'm excited to have Mark on. Mark, maybe you can tell everyone a little bit about your history, how you got here, and then we can dive into more of the stuff where we can talk about what's going on in the world today.
Great, thanks, Ben, and thanks for having me on. I guess I'll start with most recently. I was at a firm, Credit Suisse, which used to be a bank, and as we know, now is folded into the other Swiss bank, and that's really part of the story. I was at Credit Suisse from 2014 through 2021, and I was within the Prime Services division. That division provides leverage and financing to all sorts of institutions, mostly hedge funds, but sovereign wealth funds too. And my role was not really providing the leverage, but my coming in from there, I was at hedge funds, I was a chief risk officer, and I got to go into Credit Suisse and look at all of the exposures from all the hedge funds and sovereign wealth funds, and we aggregated it and anonymized it, and then shared it back to those clients to say, this is where crowded trades are, again, in a very anonymized manner, so that we're not telling tales out of school about who's doing what.
That's
and cool. What I noticed was that clients wanted that information, first of all, because the fundamentals were really hard. It was hard to be a stock picker in what ended up being a post-2008 world that was very macro, very central bank driven. So the best of the best weren't really making much money. It was all beta, a lot of it. And so that was one sort of nugget that I got from that position that I had of being able to speak to these hedge funds and why they wanted positioning data. It wasn't about what was going to play out in the long run. These waves would come through the market and knock them off and make them unwind their trades and be less profitable. And that's why the bigger hedge funds got bigger. So I started doing that. And that's why, Ben, I sort of even got more into macro, because I saw that was really, the stir mixing the drink for all of the alternatives managers. And then there was one day when I was looking at an old favorite metric of the S&P versus 10-year correlation that I wrote about in 2016 on SSRN and published it with a colleague. And it was a risk reversal signal. I loved it. But I looked at the S&P versus 10-year correlation, which changed in 2007. It went very negative, strongly negative, and it didn't ever reemerge positive. And this is, through 2020, 21. And then I said, well, let me look globally. Let me look at Germany, DAX versus Bunds, exact same. They were just mirrors of each other. And then I looked at Japan's relationship of the JGBs to the Nikkei.
Yep.
And that was different. That started in 92. It went negative.
Yeah.
And, one of these things doesn't look like the others, like a little song. So it's like, why is that? And that was the start of Japan's lost decade.
Yeah.
And so that's when I got curious and I got into Bitcoin because I was a little bit depressed, Ben. I got 4 boys, I'm married. I'm like, what is going on? How are my kids going to be able to buy a house and all this? We're going to have a currency default. But I thought Bitcoin could be that layer that we step onto as the rest of the world basically inflates out of their debt. So that's why I got involved in Bitcoin. I thought it was, the next monetary layer, and that's why we're talking today.
Right on. Awesome. I'm excited to hear more thoughts on where it is now. And I don't know if you have any comments on JGBs versus Nikkei today. We've had a pretty good run here on Nikkei. And obviously JGB's yields are creeping up and breaking through new levels that we haven't seen in a long time. Do you have any comments on that just before we roll along?
Yeah, I think Japan's inflation is well earned. They've had 3 decades of just like no growth. I mean, it's impacted their demographics. Obviously, people aren't getting married. It's the societal impact. So yes, Japan could be the cautionary tale, and also the one where you can reemerge, but you have to go through
Yeah,
3 decades of pain.
yeah,
So I think that Japan's inflation could be there from 0 to like 1.5, 2. But as it
wow,
relates to the Nikkei, I think it's like Argentina. The only reason Argentina's equity index is up is because of inflation. The only reason that Japan's Nikkei is up is because of the yen depreciating.
getting crushed. Yeah.
Yeah,
Yeah, yeah, fair enough. Yeah, certainly want to talk a little bit more about certain areas, but maybe you can give me a little bit of how then, I can see back through your history, you had risk management, which you reference, fixed income, you've been in credit, things like that. So, I'm always interested to how framework evolves over time. And I've been in business since 2000, so I've seen some evolution, and I'd say quite a bit of evolution. So I'd be interested how your framework looks today, how it's evolved, and maybe you can walk me through a bit of that, and then I'll likely pick your brain about certain areas around the world.
sure. Yeah, I came from the fixed income side. I did internships at Salomon Brothers in the 80s and got really interested in the markets that way from the fixed income side, and then equities later through the convertible bond market. Uh, Fixed income people were alert because you can only make the coupon, but you can lose the whole principal. So that they tend to be not the most optimistic or fun people in the room. You definitely want to go out with equity people. They're more upside and
Yeah,
storytellers. It's just much more fun.
yeah,
Um, but I guess your risk managers would probably be more people on the assets that are heavily levered, low volatility with heavy right tail risk, left tail risk rather. Sorry.
sure.
Um,
Yeah.
so that was my background. That probably is why I rolled into risk management. And as
Hmm.
far as my frameworks, I changed it in the post '08 crisis to be beyond just markets. There were trial balloons being sent out by treasuries and central banks trying to figure out how to just stop the train from, taking down everybody, becoming fully derailed, the financial train.
Hmm.
And what I came up with, Ben, is 3 buckets, everything. If there's a news story or a conversation, everything fits into one of the 3 buckets. Economics, the store um, of wealth, the transfer of wealth, and the generation of wealth, loosely framed. So
Yeah,
economics, markets, which are the mediums in which wealth is measured and transferred within. So markets, and then players, whether it be
yeah,
investors, regulators, etc. So anything, a topic like technology. All right, what markets are traded in? Who are the players? And how does it impact? Obviously, technology is deflationary. How does that roll into economics? So any topic goes into those three, and I construct fundamental and quantitative, like spreadsheet
hmm,
um, approaches to capture information in those 3 verticals.
yeah, yeah. Okay, that's cool. Super
It is
interesting.
pretty out. It's fun.
Yeah, yeah. And would you weight it? Does that change depending on what you're assessing? Like you referenced technology, for example, would there be different weights within that versus, say, I don't know, say you're assessing Europe as a country or as a continent. Would you have different weightings to those technology versus Europe as an example?
So I'll have an opinion on things,
Yeah,
and then I have an opinion, obviously being in digital assets and crypto now,
yeah, yeah.
where I observed that technology is powerful. So the observation I had was that the stock 600 only has like 7% technology. It's heavily luxury goods and um, industrials. So they also have low growth. So are those related? So I would dive into that causality.
Yeah.
Versus the US, where between comm services and infotech, it's like 65%, arguably,
Yeah.
technology. And we have
Yeah.
a stronger economy, even today than Europe. And then you go to China and you think China's heavy technology, but its indices are not. So
Mhm.
that's how I would I would have an opinion about the importance of technology,
Yeah.
about how it's impacted us, and then I'll look at other areas and say, wow, you don't have it. You're going to probably want it. So they pirate, there's pirating being done, appropriation without, proper channeling. That'll continue unless they can have rule of law where people like Jack Ma can be protected. So there's, it kind of, that's how I roll through it, with the economics markets players. I take a topic and
Good. Good.
see where the data leads me.
Yeah. 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 Fair enough. There's definitely lots going on in the world, though. We saw ECB raise rates yesterday, and maybe it can provide some context for where you think we are in this part of the cycle. Obviously, rates, bonds, fixed incomes, I'd like to talk about because, at least in my career, I haven't seen this kind of bond action over the last 18 months. So maybe you can give me comments for what your framework says about fixed income right now.
So the one thing that hasn't popped yet are credit, um, or the default rates. They're starting to increase. And those are stepwise functions because no one goes out of business. And today's being, someone noticed, the 15th anniversary of Lehman Brothers,
Okay. Yeah.
right? I mean,
Yeah.
everything's fine.
Yeah.
Everything's fine.
Yeah.
And then one day it ain't fine.
Yeah.
So to take Lehman Brothers as the example, and apply it to what my framework looks like today, or what it's highlighting,
Yeah.
Lehman Brothers and the profile of a company in stress is that its credit spreads go up. Number one, they invert. The front end starts to go up. So I'll go like this. The front end goes
Yeah.
higher than the long end, which means they start trading by price, not yield.
Yeah.
And then you'll see the borrowings also go from 5 years to 3 years to overnight, because no one's going to lend to these people over time.
Right.
So
Right.
Lehman Brothers did that. Lehman
Yeah.
Brothers went from a 3-year, 5-year lender, and then they ended up doing the cheapest type of lending they could do, wholesale overnight. And
Survive.
then someone pulled the plug, right? So
Yeah. Yeah.
there
Yeah.
are breadcrumbs to these
Yeah. Yeah.
dynamics.
Well, and I think even to your former company, right? We saw Credit Suisse CDOs ramp very aggressively until something broke, right?
Yes. And
Yes.
a beggar, can't be choosers, and that means that you go to financings that aren't that favorable. So that's a good tell for anybody. And Credit Suisse, not telling tales out of school, they were
Yeah.
indications with the losses, on some financing receivables that they did. And those are overnight, supposedly low return, but they can be high risk, as they found out. And then
Yeah.
Archegos, which had a lot of profile about the type of lending you do and the
Mhm.
risk you take versus the return. So those are the, risking dollars for pennies.
Yeah.
You better know exactly what's going on with those dollars.
So on the credit side, then in the U.S. is 2008 was financial related. Um, I see, as you do, 800 plus $1 billion has left the U.S. banking system this year to go into CDs and T-bills and such. You got to think there's some stress in the financial system in the U.S. Are you seeing anything there that's causing concerns?
There's nothing that I have that I can say like, a CDS spread is going up or down.
Okay.
The one part, which is more fundamental, Citibank hasn't made money since 1993 on a price basis. So they've given you
Yeah.
a 2% coupon, but
Yeah.
like that's a lot of risk for that 2% coupon
Yeah.
every year.
Yeah.
And so they haven't made it for the last, whatever, 30 years. They haven't made money.
Yeah.
It's been a pretty good market to make money.
For sure.
So as far as looking forward, more regulation,
Yeah.
technology, things are getting faster, settlements are collapsing. Do you, a current bank with legacy systems, are you positioned for tomorrow's market, today's and tomorrow's market? I think many people say the answer is not many legacy banks are.
Yeah.
So the financial system will continue, I think, Ben, in the US, go from 11,000 banks when I started. It's got 4,500 banks now. That
Mhm.
number is just going to go lower. And I think
Yeah.
the Fed's there to scoop up all the pieces and jam them into other banks as they see. So that's going to continue. To your
Consolidation.
point
Yeah.
about
Yeah.
deposit volatility, yeah, people can move stuff quickly.
Yeah. 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 So do you see any, obviously, because you sit on the digital side now, do you see any good banks coming out? Well, maybe not banks, we'll say new fintech or such, starting to come out of the system that can facilitate we still need the traditional. So you can, like, are you seeing any fintechs come out that are showing some good promise, or areas maybe even showing some good promise?
Yeah, you're right about um, digital assets aren't going to all of a sudden, not everyone's going to be trading on Uniswap
No.
or or have a cold wallet and manage their assets that way. Not everyone's Ben Hart, Fred Pine and others.
Yeah. Yeah.
So I think you're gonna, we call it the Great Migration. And the migration is that you're seeing folks like, I mean, Fidelity's been in the market for 5 years, and they're evolving to increase more offerings on a liquid basis, and that's all public. JP Morgan, whose chairman called Bitcoin a pet rock and all that other stuff, he's had a group focused on Ethereum for the last 5 years, and he's
Wow.
doing
Yeah.
cross-border settlements on FX, and he has a repo program on chain
Well,
using ERC20 tokens.
okay.
I mean, he's a crypto bro, essentially.
Yeah. Yeah.
I mean,
Yeah.
he's just
Yeah.
missing the hoodie.
Yeah.
So I think the banks are gonna integrate. They are integrating because you want to add value. The bank's value is that they're regulated, that they have clients, and they had products and services that worked. That
Mhm.
last part, product and services, have to be more tech-based. They have to
Yeah.
have immediacy, and that's why they are doing. Even the Bank for International Settlements is doing a project. I'll think of it, Mariana, I think it's called,
Okay.
where it's a wholesale central bank digital currency
Hmm.
with France, the Monetary Authority of Singapore, and one or two other entities. And they are also using Ethereum. They're
Hmm.
using an ERC20 token. It's public,
Okay.
it's on their website. So
Yeah.
it's
Yeah.
it seems almost at odds. Everyone's like worried about crypto, and yet you have the central bank of central banks moving and settling assets on it.
Yeah. Yeah. Yeah, I always find it interesting how these things are evolving behind the scenes. But I guess, into your point, in public record, if you're willing to look for it, and there's still an overarching sense that it's used for illegal activity. I'd say in the general thinking of conversations that I have in media, still portrays it that way.
Mhm.
So that kind of brings up a thought in my mind around CBDC. Wasn't certainly interested in your opinions of it, but since we talked, you kind of led me there. Maybe some thoughts on central bank digital currency, And certainly I'd be interested to hear your opinion on the recent BRIC meetings discussing potentially a settlement currency, but maybe just start with CBDC.
So the CBDC would be an evolutionary step from the book entry. I mean, basically the dollar is digital now because it just goes back, but it's not on chain. It isn't necessarily controlled. Like, so if I borrow money from a bank, I can convert it to cash and put it in my pocket.
Yeah.
Or I can transfer it to another bank, maybe outside the U.S. jurisdiction. Then the U.S. has less control of it. Like euro dollars, not again, our dollars outside the U.S. traded abroad.
Yes.
Central bank doesn't really have control over that. They benefit because it's so. Back to CBDCs. CBDCs take dollar bills are obviously paper with a serial number.
Yes.
It went digital when they threw the paper away and they just took the serial number effectively and put it in a book of record so they can transfer it over the internet or telegraphically, etc. So that's where we are today. Central bank digital currencies then would take that step of the serial number being digitally traded on a digital ledger to actually tied to a chain that I would have, say, the private key to. The government would know my private key and the public key. So they could actually give it to me. And what people are worried about, they could also take it. The one concern about a central bank digital currency, and I'll go into the constructive parts of it, which there are, is that on a stimulus basis, the government can say, we're going to do stimulus, we need it now, and you need to spend this money in 2 weeks. We're giving it to you, but you need to spend it in 2 weeks. It's like a coupon with an expiry. Maybe that's a good thing. I don't know, but that's what CBDC gives you.
Well, we saw they tried to do that in Japan, right, in the 90s, and people just saved them anyways, and they went away useless. This might be different if it's on a card and people are much more used to tapping and spending. So, interesting.
And then the other part that I think people are hoping what the digital CBDC would do, the velocity of money globally has just dropped. There are reasons why people are, marginal propensity to consume by wealthy people is a lot lower than the lower income, and the money resides in the higher income. So the velocity's dropped, and the government could use CBDCs to try to divert or change that behavior to accelerate the money intraday for everybody, but also maybe direct some cash to people at the lower end.
So maybe a couple comments on, because you referenced euro dollars, maybe a couple comments on potential risk to euro dollars and the BRICS talking about, we'll say, a neutral settlement currency, hypothetically not backed by gold, but we'll say not pegged, but referenced to gold.
I think it would have to start with trade. So the trade agreements among those countries would have to be, it would take 5 to 10 years to establish terms and conditions where trade would happen, and then they would be able to agree on how it's settled in a like an SDR, like UN experiment currency for the BRICS, like a euro. So I think that's a long ways off, but it's nothing to be sneezed at. Those countries used to be 10% of GDP, now they're 30.
Yeah, for sure. So you reference SDRs, maybe just clarify for people, what's an SDR and who settles in SDRs?
All right, so SDRs are they actually, is it depository receipt? It's not special, it's I forgot what the
it might be a settlement deposit receipt or something along those lines.
So the SDR is a creation by the United Nations in order to potentially create a new reserve among the United Nations members that would challenge the dollar. And in fact, it is a unit of measure for contributions to the UN where they convert dollars and all currencies into SDRs. So it's a captive unit, doesn't really trade as a unit of measure. So that's what the SDR is, and people like Soros and others would like to see it become a global reserve. It just hasn't picked up. For several reasons.
Yeah, I mean, I think the digital framework, to your point, and the blockchain, probably to your point, allows the ability for those to happen now that probably didn't happen 10, 15 years ago, 20 years ago. We're certainly moving closer towards that. Just before we leave the currency a little bit, obviously it seems like the Saudi government has been maybe changing tactics a bit on oil, US dollars. They're joining the BRICS. Any thoughts around that and potential impacts in the world?
Yeah, I don't know if you remember, and I think I have the dates right. Remember in March of 20, when COVID, really became hot. On March 9th, I think oil like tanked. It was the biggest drop. I think interest rates, the 10-year went to like 30 basis points. There was a big shock in the marketplace. I think that was the same day that Saudi Arabian oil fields were rocketed by, I believe, Russian by Russia. They were attacked.
Okay.
And it was amazing. It was when things were hot. It's almost like, mom and dad are busy and then the kids went wild.
Yeah.
So the US was overwhelmed with, as the world was, and then things went a little haywire for a minute. We're supposed to protect Saudi Arabia. That's the benefit of the petrodollar. And we were occupied. So I'm not saying Saudi Arabia decided to take matters in their own hands, but I think that was a moment when you say that's an indication that, the US is, not, losing its, its hegemony or its leadership a bit, and it's becoming, a bit more of a multipolar world.
Yeah. Interesting. It's I think my personal view is we probably reached peak globalization the day before Trump got into power, and then I think we've been going the other way since then. Maybe it was before then, but that's a good point and point of reference for you. So maybe then let's talk a little bit about what's going on in the, let's say, blockchain crypto landscape. Fed Larry Fink out quite active. Had the SEC continuing to be the focal point. Maybe you can just give a framework for what you see happening today from the inside, and then we can all stick handle. I got some more questions along that lines.
Stick handle like that. Yeah, that wasn't lost. Even the New Yorker picked that up. So I do want to touch on one thing you said about peak globalization. You sort of dropped that. Like, that's a whole nother podcast, but we like, that's huge. That's why we're having inflation, because we're no longer, working as a coordinated global unit, importing cheap, products and cheap labor, all that stuff. So that's something we'll put to the side, but it's definitely a huge topic. Given that, all the more reason, if we have reached peak globalization, which you stated, and I think there's a lot of evidence to that, and I agree, then we sort of have to figure out, well, how can we mimic some of the optimization that we had from global trade, which is now dissipating. And blockchain's one of them. I mean, to be able to have immediate settlement, you basically have Price Waterhouse and Ernst & Young auditing your books every 10 minutes. That's Bitcoin in particular. You have tremendous scaling opportunities on Ethereum that everybody and their mother, father, and are trying to incorporate into their traditional financial system.
Mhm.
And as you mentioned, Larry Fink, who was not a fan of this stuff, I don't know who prompted him in the green room before he went on and said that. But can
Yeah.
you imagine? He was like, do I really have to say it's good? I've been saying it's
Yeah.
bad for so long. Do I really have to say it's good? And they're like, yeah, Larry, you do, because
Yeah.
we need to get involved in this. It's happening. I mean, that would
Yes.
be
Yeah.
such a fun little vignette if we got a little look at that.
Absolutely.
Because I don't think he himself is as convinced as his partners are. He sounded not like he was as well versed in it as other people are.
Sure.
Um,
Yeah. Yeah.
but they're in it. So
Yeah.
before he went on was at June 15th. They dropped the bomb.
Yeah.
There are two things, if you want me to go into this, that I think it's
Sure.
coordinated and underscores their commitment.
Okay. Please.
The first is June was a big month for digital assets, crypto in particular, because the SEC on Monday, June 5th, filed suit against Binance and CZ in particular as well.
Mhm.
He was enjoined in the suit.
And just for everybody, CZ's the owner and founder of Binance. Go ahead.
Yes,
Yeah.
Chang Zhang Peng. I think if
Yeah.
I got that right.
Yeah.
And the next day, June 6th, and I don't think it's by accident, the SEC filed a suit against Coinbase, another exchange, US listed, and the opening pages were almost identical. I believe the Coinbase suit was 104 pages and Binance's might have been 136. They went after Binance for more charges, including, I believe, some criminal, I believe.
Okay.
But Ben, they were conflating the two. They're like Coinbase, Binance, same thing. It's like, no, it's not, guys. It really
Yeah.
isn't. But they
Yeah.
were really working to conflate them.
Mhm.
And Coinbase stock went down like 20% intraday and all that. BlackRock on June 8th filed in Delaware, unbeknownst to anybody except I think one of the outfits, maybe CoinDesk, picked up on it,
Mhm.
to start the process of the ETF filing. So it was a non-public filing in Delaware, and they did it in order to support Coinbase. That's my opinion. Because then they
Wow. Okay.
did another
Yeah.
filing and they included Coinbase as their agent for the surveillance.
Right.
Eventually, they came out with that,
Yeah.
which the
And all the
SEC asked for.
yeah, and all the others did the same, right? Coinbase, I think, was going to be for Fidelity,
All
and
of them,
all of them. Yeah. Yeah.
all coordinated. So the Nasdaq
Yeah.
is
Yeah.
the public exchange that then enjoined Coinbase as their surveillance partner for all the S1s,
Yeah.
Fidelity, ARC,
Yeah. Yeah.
all of them. So Larry Fink got up on stage, but behind that was they didn't just create the idea. That thing was ready to be popped, that ETF. It was there. And
Yep.
they went and started to support Coinbase. They said, enough's enough. We're going on. So I think that's probably the most underreported dynamic and one of the most important.
Sure. Yeah.
The
I wasn't
second
aware.
point,
Yeah.
what's that?
I wasn't aware of
Yeah,
how
yeah,
that. I mean, I remember the dynamics, but I don't remember them like that. Interesting.
yeah.
Yeah.
And the second point that I think back to, I think Larry Fink's growing to love it, but the firm is already there,
Hmm.
is in February of 2022, 3 representative or employees of BlackRock from their quant division, led by a gentleman named Ang, A-N-G, published on the SSRN website a white paper called Digital Assets as a Diverse Portfolio Diversifier, something like that.
Hmm. Okay.
And in it, they said Bitcoin provides a diversification benefit, more upside than downside, essentially better than any other asset that we've seen. Those are my words, but they essentially said it pretty close. It didn't get attention until maybe July of this year.
Okay.
At all. And it blew up on Twitter and everything else, maybe because BlackRock filed. We've done the same work, but we didn't, I didn't do the work until maybe August, July, August of last year, about how Bitcoin has a very different return distribution, where it's, by definition, it's logarithmic. It tends to have a very big right tail. And so like an average in the last 5 years, the worst quarter in Bitcoin was down 60. The best quarter was up 260. Okay. No other asset gives you that. Oh. And BlackRock's team then went into statistical analysis about how a client, back to my economics, markets, and players, they took a risk-averse and a risk-seeking client, and they said both of them would love a 60-40 portfolio with anywhere between 3 and 85% Bitcoin. They actually said 85%. Okay. I don't say 85%, but they said it. Yeah. So BlackRock's done the work. They're convicted. It's coming, and they're going to sell it up and down through their risk management system, Aladdin, to all the funds. So that's happening. Okay, interesting. So do they obviously they're big enough that they can play in futures, options, forwards market, but do they need this ETF? I think you need the spot Bitcoin ETF for a number of reasons. I mean, you mentioned Fred. Yeah. The reason Canada's a tenth the size of the US. Why do people care about even our firm at all? Because we have a regulated spot ETF. It tracks Bitcoin, with a tracking error of of pennies. Yeah. The futures product and options have decay, they have slippage. It serves a purpose. It's better than nothing. Yeah. But a spot you have to have it. Well, especially if you're going to hold it as a asset allocation long term. Yeah. Yep. Yeah. So you referenced briefly there 60-40. I know you've written about Markowitz and that kind of efficient frontier. Maybe you can provide some comments around what that means. I mean, you and I know that this kind of 60-40 thinking, and we went through this period of about 10 years where everyone thought bonds were dead forever. So maybe you can give us some comments around 60-40. And I know the work that you've done shows that Bitcoin actually provides better returns with less risk. So maybe you can elaborate on that. Sure, and I'll start there, Ben, and tell me if it's too wonky, but when I talk about Bitcoin's behavior. So we just referenced the fact that Bitcoin has more upside than downside in any given quarter over any kind of rolling 4-year period. Not kind of, in any 4-year rolling period. Yes. So the way that looks at statistically is people use a term volatility, which is bandied about a lot, but I'll try to give a layman's definition. If you expect the weather on any given day in September to average, I shouldn't use temperature. You can use Fahrenheit. It's okay. We'll convert it. Could be 68 degrees Fahrenheit. Yeah. With a variance of +5 or -5. That's what people would describe weather. 68 degrees ±5 degrees. That gets you about, that's like 85% of the days in September in the last 10 years. So I think you don't need to be a statistician to understand that is clear. Gotcha. 68 ±5. I now know what to bring to New York in September when you come visit. So now you know. Exactly. Yes. Good example. Statistically, you would say that the mean temperature is 68 degrees, but it has a it has a, say, let's say it's plus minus 10 degrees. It has a volatility of 10%, let's say, 10% volatility, which means that in New York in September, I'm going to be okay, but I could be off by, 10% plus minus, the bell curve and all that stuff. Good. And now what we'd say is, well, let me look at only the, say you love warm weather. We'll call warm weather good volatility. Sometimes it's warmer. That's good because I like the heat. We'll call that good vol. So the volatility to the right of that 68 degrees, when it gets to be 70, 80, maybe 90, that actually is 20% volatility. On average, it's 10, but when we only look at when it gets warmer, it actually gets really warm.
Yes. So
let's look at the other data. When it gets really cold, well, it actually only goes down to like, say, 64 degrees.
Okay.
So you're like, wait a minute. You said it was 10%. I'm like, yes, in the aggregate. But when you break out and you look at the good weather and the bad weather, there's more good weather in New York.
Yeah.
So that's not a normal distribution. That's not the normal bell curve.
Yes.
Bitcoin has more good weather. It's crazy. Yeah. So the S&P, look at that same bell curve, is kind of normally distributed. It actually has a bit of a fat tail, a little bit of a, people say when people are more anxious, will act quicker being anxious, and to be in a good mood, it takes longer. So, but to be in a bad mood, it can happen quickly. So that's so financial markets tend to have a bit of a fat tail, bonds especially. Bitcoin, let me give you numbers. The large cap, US large cap index, which mirrors the S&P, it's by Bloomberg, it's in our analysis. Yeah. Everyone knows you make like 8% a year in the last 30 years on average in the equity markets, with the tech component in the US. Fine. It's average volatility, you say 10%. On the good days, when you only look at positive returns, the volatility is 8. On the bad days, it's 14.
Wow. Okay.
You have more tears than you have smiles. It's that way.
Yeah.
The bond market, up vol is 2%. Down vol is 4%.
Okay.
All right. Now we're going to switch gears here. In Bitcoin, the volatility in the last 5 years averaged, say, 60%. It's now lower. It's like 35. But in the last 5 years, it averaged 60. Yeah. Versus 10 in the equity market.
Yep.
The upside vol was 130. The downside vol was on the order of 40.
Wow.
It is flipped.
Yep.
That's what Ang and the BlackRock guys, when they saw that, they're like, hey guys, call home. We're not going. We're going to finish this paper now. Yeah. And it's the number one fact when I talk to RIAs. Yeah. And I didn't know it until, last year. That no one appreciates.
That is super unique. And maybe any thoughts around why?
Exponential growth.
Okay.
So we talked about so with exponential growth, you have more people entering the system than leaving. Okay. When you have more people and limited supply, I believe the dynamic, and this is my conjecture, that you will have more upside than downside. It doesn't mean you don't have volatility. We had a down 65% year last year. Yeah. Yeah. But over time, and we've seen it. Yeah. Bitcoin has outperformed all equity markets in any rolling 1 year, in any rolling 4-year period. And there are more people using it. Yeah. So I think that's it. Tesla for a period of time had a similar, not as large dynamic.
Yep.
until it matured. So it's not unusual. It's
Sure.
just if you follow the narrative that this is the new monetary global or a monetary layer for the internet,
Yeah.
and you only have 100 million people in it and 8 billion
Right
people on the
now.
planet,
Yeah.
that's maybe one reason why Bitcoin, by BlackRock and others, had the paper ready to go. And when they saw
Yeah.
BlackRock go, everyone hit send.
Exactly. Sorry to get in the weeds a bit just on we talk about volatility. Obviously, it's VIX on the S&P is what you use, and the MOVE index on bonds, I assume.
Yeah, so I use the
Yeah.
move in, both are options based.
Yeah.
When I was quoting those, I was actually using realized volatility from the prices of the indices themselves. The
Okay.
VIX, as you know, is based on the most recent options, and it's the most quoted. So yes, it's the one we should be talking about.
And then for volatility for Bitcoin, how do you track that? What's the way to track it?
There's no measure out there. We produce it ourselves. We
Sure.
publish to it.
Yeah.
And the measure that I like to look at is relative to the Nasdaq, since Nasdaq's tech heavy,
Yeah.
and people said, last year it was correlated heavily to Nasdaq. The
Hmm.
volatility trend, which it was last year,
Yeah.
the
Yeah.
volatility trend of Bitcoin relative to Nasdaq has gone from 6 times more volatile 7, 8 years ago
Hmm.
to 2.5 times more volatile today.
Okay. Awesome. Maybe a few comments then just about where we are with the SEC, and then we'll have maybe a couple of wrap comments just on the state of the world and economic your views on where we see GDP inflation going. But Gensler, SEC continues. It looks like we're in, I don't know exactly where we are, and GBTC continues to rumble their way through. Maybe a couple comments on where we are with an ETF, with the SEC, and maybe a comment on GBTC, and then we can go to the next.
Sure. On the SEC, I think it's a 5 commissioner panel. On the one end, you have the Gary Gensler, who's done treasury work. He's been in public service before this, and he's had a clear stance against digital assets in particular. He has made a distinction that Bitcoin is the only non-security. I'll use the word waffled. He definitely did not answer a question in June in Congress on whether or not Ethereum was a commodity or a security. He chose not to answer that.
Got it. Okay.
So
So he says Bitcoin is a
commodity
security, a commodity.
is a
Okay, perfect.
commodity.
Got it. Got it. Okay.
Other than that, I think it's fair to be critical of the lack of clarity, or his statement that we already have the 33 and 34 Act, or the 40 Act rather, and we don't need to do anything else. I mean, judges have come out and said otherwise. So I think, and we said this in our 2023 outlook, I look at Bitcoin, Ethereum as almost back-end equities or assets, like a distressed asset going through. It's a pristine asset. There's value. It just has a bad capital structure. We clearly had bad managements last year with SBF. Can't wait to see the movie,
Yeah.
and and Machinsky and others
Yeah.
who have been convicted criminally.
Yes.
So the courts are going to have to provide the clarity in the U.S., and
Okay.
it's happening.
Okay.
But Europe and UK are realizing they need technology. Back to how we
Yes.
started the call at the top,
Yeah. Yeah.
and they're inviting people in to create and build there. So I don't get it with him. He's hurting the U.S.'s opportunities for sure.
Yeah. Yeah. I agree with that. I think that conversation about the UK and where they are is probably another conversation for another day, because I think they've gone a long way forward. But I appreciate your time, so I don't want to take too much of it here. And maybe you can give me, let's bring it on back to macro and say, Where do you think we are? Obviously, lots of attention going towards inflation and the central bank still. Where do you think we are from what's the next quarter or two look like, at least in your views?
Uh, I'll start by going to your globalization comment. When that changed and we became more balkanized with onshoring, reshoring, that increased cost structure. So inflation is here. I don't think we'll ever go back to a 2000, 14, 15, 8, that kind of 2 to 3% tenure in the US and similar in Canada. That's gone. Costs are higher. It's going to cause cost of money to go up. We don't have those efficiencies on the whole part. The other one is that we talk about inflation as if it's one number, but it's a vector.
Yes.
So if you're in business or if you're in investments with Ben, you have to look at what do you own and does it have the benefit? Is it lifting with inflation like assets? And hopefully your cost structure, you're benefiting from technology's deflation. So it's never been more important given this higher rate environment and cost structure to understand how your home, business, etc. operates, because that vector is going to become much more wider and a greater topography to manage, because complexities are going to increase as costs increase. So that's number one. As far as
Interesting.
Having something concrete to say, we need credit defaults. We need defaults. We haven't had them in a long while. That's going to be an opportunity. That's going to be the bottom in the market. So I would be, stick to your knitting, what you do now. Obviously, I have an opinion about Bitcoin and Ethereum, about their opportunity. But for the traditional asset space, defaults, that's one thing to look for.
So if somebody was looking to track that, is there an area where you would track defaults? Or obviously you can see it in the world, but is there an index or something? Is there something you track, or is it aggregate for you?
The CDX high yield would be one measure to watch. I also believe regional banks, they're going to be feeling it, and that's a liquid market. That's another one.
Awesome. Is there anything you think I should have asked you today that I didn't, that you'd like to add before we wrap here?
Not at all. It was a pleasure. Thanks a lot, Ben.
Awesome. That's great, Mark. Listen, I really appreciate you spending the time going through your framework today. I love the 3 ideas that you have, the 3 buckets where you think about the world. That's super cool. I like that. It's a good way to think about things. And hopefully we can have you back on. I know we said maybe globalization conversation, maybe the best digital countries in the world might be another conversation. So if you're up for it, I'd welcome the chance to have you back on if that works for you.
Perfect. And on any of these topics, if it's okay, can I relay the website that has our research in case people have questions?
Please. Yeah, absolutely. Yeah.
It's just 3iq.io.
Okay. If somebody wants to get in touch with you, what's the best way to do that?
The website will be good, or else mconnors, MCONNORS at 3iq.ca.
Okay, perfect. Excellent. Thanks very much, Mark. I hope you have a great weekend, and we'll talk to you again.
You bet. Thanks a lot, Ben. Cheers.
Thanks, Mark. Take care.